Welcome to The Explainer. Today, we're jumping right into a wild financial contradiction with Versant Media Group, ticker symbol VSNT. We're going to look at the 7 red flags and the 7 green flags that Wall Street is hiding from you. Okay, let's dive into this ultimate investor mystery. Is this newly spun off media giant a misunderstood bargain or a highly dangerous value trap? Versant Media is a company that has a lot of brilliant people on Wall Street scratching their heads right now. And today we're going to unpack exactly why. And this paradox is brilliantly illustrated right out of the gate. Versant is trading at a microscopic 7.1 times trailing earnings. Meanwhile, the rest of the media industry sits way up near 28.8. A massive valuation gap like this usually means one of two things, right? It's either the deep value opportunity of a lifetime, or there is something fundamentally broken under the hood that the broader market is pricing in. Section 1. The Setup. The VSNT Enigma. To understand what's going on, you have to look at what they actually own. Spun off from Comcast in early 2026, Versant commands an absolute empire of iconic brands. We're talking CNBC, USA Network, Fandango, and MS Now. This gives them massive global reach. They hold a market cap of roughly $5.38 billion and a stock price hovering around $38. They are an established titan in the entertainment space, yet somehow they're priced like a failing business. Section 2. The Bear Case. 7 red flags. Let's look beneath that shiny surface. Delivering the bad news first, we have structural and narrative warnings flashing red across the board. The platform Guru Focus alone has flagged 8 separate warning signs, citing serious challenges in growth. Even more concerning is their Altman Z-score. This is a metric used to predict bankruptcy, and it currently sits at 2.97. That puts them squarely in the financial stress gray zone. If that drops below 1.8, the bankruptcy risk becomes very real. Add to that a highly concerning lack of an economic moat, which we'll dig into shortly. So the crucial point here is that secular declines in linear TV are literally bleeding into their actual financials. Total revenue has dropped to $6.6 billion, a 3.6% decline year over year. But the real shocker? Net income has cratered over 38%, down to just $758 million. Linear distribution revenue specifically is down 6%, simply due to widespread subscriber cord cutting. It's taking a huge bite out of their bottom line. And to cap off the red flags, the Q3 2026 earnings per share estimate just crashed to a paltry 29 cents. That's down from an expectation of 37 cents just 3 months ago. This drop is largely due to skyrocketing sports rights programming costs. You see, to stay competitive, they have to pay a massive premium to air live sports, which means their adjusted EBITDA, which is basically their core operational earnings, likely won't demonstrate any growth in the back half of the year. Section 3. The Bull Case. 7 green flags. Let's shift gears and look at the upside. First off, a discounted cash flow model from Simply Wall Street suggests the stock's intrinsic fair value is actually $64.59. That is incredibly important because it means the stock is trading at a massive 43% undervaluation discount right now, based strictly on its cash generation capabilities. And management is heavily backing this undervaluation thesis. They've already returned $305 million to shareholders this year through highly sustainable dividends. When I say sustainable, I mean they have a 2.1% yield with a 0% payout ratio, supported by a massive 36% free cash flow yield. On top of that, they're announcing another $100 million in accelerated share buybacks. They are aggressively putting their money where their mouth is. Furthermore, they're actually beating estimates in the present moment. Q2 saw revenue hit $1.64 billion, which slightly exceeded analyst expectations, and they pulled in an earnings per share of $199. This solid performance prompted management to confidently raise both their full-year revenue and adjusted EBITDA guidance. Now, what's really interesting is how they are actively combating those linear TV declines. They're executing a massive strategic pivot, driving nearly 3 billion digital views across MSN Now on YouTube and TikTok. CNBC just enjoyed its highest-rated quarter in over 5 years. Beyond that, they're making aggressive expansions into free ad-supported streaming, or AVOD, under Fandango. They're pushing direct-to-consumer streaming and securing premium sports rights for the Premier League, NASCAR, and the WNBA. Section 4. The Verdict. Investment Framework Showdown. If we look at the methodologies of the investing greats, Versant passes Benjamin Graham's value tests, scoring 5 out of 7 criteria, largely due to that incredibly low PE ratio and a very healthy current ratio. But elsewhere, it completely bombs. It fails the Guru-focused mode assessment, the Peter Lynch model, and the Warren Buffett model, scoring a literal 0% on those last two. Ouch. So why did they fail? Well, Peter Lynch and Warren Buffett demand consistent earnings and durable advantages. Versant's declining earnings, combined with almost 83% institutional ownership, trigger automatic failures in those models. The declining net income results in a negative PEG ratio, meaning their price simply doesn't justify their shrinking growth, which is a massive red flag for Lynch. Plus, the short operating history post-spinoff makes it entirely too unpredictable for a Buffett-style investor.
GuruFocus really hammers home the ultimate structural weakness for long-term investors. They note that Versant has virtually no intellectual property or cost advantages to protect them. In the media and advertising world, if you don't have a moat to lock in your customers, it means you have to constantly outspend your competition just to tread water.
Section 5. The bottom line: execution risk versus deep value. Because it lacks a durable competitive advantage, this is definitely not a safe, steady compounder. Rather, it's a speculative bet squarely on management's ability to execute their digital pivot before pay TV declines accelerate. It is quite literally a race against time to replace the old revenue with the new. So if you follow Buffett or Lynch, it's a hard pass. But for a deep value contrarian, the high free cash flow yield and low PE make it a highly speculative buy, definitely worth monitoring over the coming quarters. The smartest recommendation here is to wait for hard evidence that their new digital revenue growth, like the Fandango streaming launch and their direct-to-consumer expansion, is actually offsetting those linear TV declines before committing significant capital. That wraps up our explainer for today. I'm going to leave you with one final question to answer for yourself. Are you betting on the digital pivot or avoiding the linear decline? Thanks for joining me, and I'll see you next time.